This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Ole Hansen's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a drawdown of 2 million barrels of crude oil, Cushing, Oklahoma drawing down a de minimis 18,000 barrels, gasoline drawing down 3.3 million barrels, distillates building 624,000 barrels for a net petroleum drawdown of 4.6 million barrels. U.S. production held steady at 13.1 million barrels, unchanged from last week. We've got a clear breakout above $80. That was the round number resistance we were fighting with for the last few weeks. That suggests further upside to come. But echoing what Ola said, I can't get too excited in an environment of increasing spare capacity for this rally to go too much farther. So I don't think we're headed back towards $100 prices anytime soon, unless there's a geopolitical escalation. And of course, anything is possible on that front.
Well, Eric, it was a very clean breakout on crude oil, and it remains well above its 50-day moving average. The pattern of higher highs and higher lows continues. And I get the whole idea of spare capacity and a lot of the reasons why a lot of people are relatively skeptical about the sustainability of this rally. But the one thing I reflect on is that the substantial volatility both to the upside and downside is an inherent feature. And right now, the sentiment, not very many people are buying into this oil rally. For me, it still wouldn't be a shocker if the oil market made a couple pushes higher. Like, even though all of you will end up being right that spare capacity kept oil trade ranged, it doesn't mean we can't print 90 before going back to 75, and the average price for the year ends up in the low 80s. And so here, the trend is still in your favor. And if old dips end up being bought in the $79, $80 area that keep it above the 50-day moving average, I'm still in the camp that there could be a few more bullish impulses on the upside of crude. So let's move on to equities. Eric, what's your thinking here?
Well, the FOMC statement and Jay Powell's dovish comments in the presser propelled stocks higher. As I've said before, I see this as a melt-up that doesn't make a lot of fundamental sense, but it shows all the signs of continuing higher.
All right. Well, I want to get Nick involved in this conversation. Nick, on page 3, we have the S&P 500 index with your levels. So what are you thinking here, bud?
Spot price right now on SPX is approximately 52.50. We have a call wall above at 52.50 and a put wall below at 5100. Now, the implied move for the April 19th monthly OPEX is plus minus 130 points. Therefore, the upper implied move is 53.50 and the lower implied move is 50.90. Right now, we have key resistance above at 52.50, all-time highs, and key support below at 5100. I'm inclined to think we see a pop now toward that 5300 mark as we get a blow-off top in the market, given Powell's commentary. And right now, we have the next FOMC meeting coming April 30th and May 1st. So that's probably the next volatility-inducing event we're going to see. But until then, I'm kind of bullish short-term.
On page 4, I have that S&P 500 futures chart on the continuous with that 50-day moving average. And the one thing we've seen relentlessly since the start of the year, literally started in January, was this pattern of higher highs and higher lows in this crawl higher. And every single dip gets bought pretty much systematically at the exact same time. You know, a quick little retrace, multiple days, and then pops higher. We're already slowly approaching some of the short-term swing high targets, which, would be expected to have a similar pattern, which is it pauses, retraces, and then advances again. It clearly is that the primary trend is up. The bulls are in control, higher highs, higher lows. Price action is bullish that way. But this is an incredibly overextended market. And really, at some point, All it will take is one surprise catalyst, and quickly everyone that is rushing to buy simply because they feel that this primary trend is in control will quickly start to try to flatten their positioning. What will that trigger be? I don't know. But right now, the bulls are in control. On the S&P futures, I'm looking for about 53.50, which is about 40 more S&P points higher, and we'll see whether or not the market consolidates there. And moving on to the Nasdaq chart here, Nick, what levels are you watching?
Spot price on Qs right now is approximately 446. We have a call wall above at 450 all-time highs and a put wall below at 435. The implied move for the April 19th monthly OPEX is plus minus 16 points. Therefore, the upper implied move is fresh all-time highs at 462, and the lower implied move is at 430. Right now, we have key resistance at all-time highs at 450 and key support at 430. As I mentioned on the S&P, I'm bullish short term. Longer term, I'm more cautious, especially on tech names. I mentioned last week that Google and Apple were longer term buys as they were hitting their lows. And Google had a nice bounce on Monday with that news that they're going to possibly be licensing their Gemini software to Apple. Apple also popped at that news as well. But I'm short term bullish on certain names. I'm being very selective here. I'm not, broad market saying I'm bullish overall. You got to be very, very selective as we hit these new highs.
All right. Well, looking on page 6 here, Nick, we have the volatility index, and here we are at the 12 handle. I mean, at this stage, the bull continues. There was a little bit of volatility premium priced in for just in case the Fed meeting became a pivot. But clearly now in the post-Fed period, we're coming right back down to the year lows. What are the VIX levels telling you?
Yeah, so with the VIX at approximately 13, we can expect intraday top-to-bottom moves of approximately 0.75%. And right now what we're seeing with the VIX near lows is very, very cheap insurance on longer-term time horizons. That being out-of-the-money puts in the event of some exogenous event occurring, causing market volatility to increase suddenly. As I mentioned previously, the next FOMC meeting is April 30th and May 1st. So that might be the next volatility-inducing event. But right now, given that we're in this swing to the upside with the bulls in control, it's hard to really say that buying puts in the short term would make a lot of sense. I do think that volatility will decline into that FOMC event. Thereafter is anyone's guess. Now, moving on to page 7, we have the U.S. Dollar Index. What are you guys thinking here?
The FOMC statement seemed at first to suggest that the Fed didn't think inflation is done, just as Jim Bianco told us recently here on MacroVoices. And the dot plot seemed to indicate that further hiking was on deck in 2025 and beyond, but not until they first made sure they got those 3 rate cuts in between now and the election, which of course is not at all politically motivated in any way. Then Jay's speech crushed those hawkish interpretations when he insisted that the dots don't represent a plan or strategy. I think Jim Bianco has it exactly right. Inflation has probably bottomed, and the fantasy of many traders that we were about to begin a rate-cutting cycle that would take us all the way back down to 2% or 0% Treasury rates or whatever they thought was going to happen. No, I don't think so. I think we're going to get a few rate cuts in 2024, which seem to me to be politically motivated, and then the data seems to suggest that we may go back to a hiking cycle after that. Now, if Jim Bianco is right on the timing, that means May or June for the first cut.
My view is that the dollar hasn't revealed its hand yet. The 104 was a very key level for the dollar to beat. And as it approached it, it stalled out there, and it certainly paused there in the post-FOMC. But at the same time, all pullbacks in the dollar have actually been very well contained and bold. And on top of that, you have the U.S. dollar yen about to break to a fresh high. And so the dollar index itself is in the dead center of its one-year trade range, and it really hasn't shown its hand. At some point, the dollar will signal some sort of intermarket move, and a lot of risk assets will reflect. But right now, the dollar is somewhat trendless, and FOMC was not the trigger for a big currency move. And so we'll wait to see whether or not some sort of more meaningful move happens here. Right now, just respecting the trade range is all that we can really do.
Now on page 8, we have that gold futures chart with gold breaking to new all-time highs. Eric, what are your thoughts here?
Well, I was expecting and hoping for a deeper correction in gold so that I could put some more size on my long position. But of course, as soon as Jay Powell crushed those expectations that were set by the dot plot, we were at new all-time highs by Wednesday's close. So the correction is probably over, and 2300 is likely the next near-term upside target, just as Ola Hansen said in this week's feature interview. The longer-term cup and handle pattern still has targets around 27.25, but that could take a year or more to play out, and given the dot plot, I'll be taking profits on my gold longs around election time later this year.
Eric, the 2300 number that you suggested as a near-term target has been a number I've been watching closely as well. And I am in the camp where on the very short term, gold is in an uptrend, making higher highs, pushing trend, taking flows. No reason why something like 2300 couldn't be achieved. In the bigger picture, though, the real big gold bull market is likely to be occurring during an easing cycle, during a period where the dollar is generally weak in some sort of a downtrend. We haven't seen those bigger picture conditions really start yet. So after gold finishes this move, it would be very natural for it to backfill and retrace. Overall, gold's been very bullish, all-time new highs, holding up along there. There's no reason not to believe gold will stay up there. The bigger question is this the beginning of this extraordinary move that will hit 2,700 or 3,000 on the upside? And while I think over time those upper targets are 100% in play, the question is this breakout we just saw here in March, that beginning of that move? And that the jury's still out on that. I agree with you on the 2300. We definitely have room to go a little bit higher on the short term, but it'll all be about the way it consolidates here into the summer that will be the big tell for me.
Now to finish up, guys, we have this chart on uranium. What are your thoughts?
I was hoping for another leg down before the correction ended, but it's starting to look like the bottom is probably already in, although it's early to say that with conviction. The deep value play here, if you don't mind some geopolitical risk, is in Global Atomic, a ticker symbol GLO. Now, the backstory here is Niger, and if you're not sure what I'm talking about, the West African country that's uranium-rich and looks to English speakers like it ought to be pronounced Niger. Well, that's a French-speaking place, so it's pronounced Niger. And their situation, they had a coup, essentially. They have a military junta which is in control. They were accused by the United States of maybe getting ready to sell uranium to Iran, and they didn't take very well to that. I think the United States felt like they were going to test their mettle or something, and the reaction of the military in Niger was basically, get out of our country, you're not welcome here. And the U.S. is now backpedaling and saying, well, but wait a minute, we were going to build a couple of very strategic bases here. You have to let us stay. What do you think you are, a sovereign country that gets to make up your own rules? We're the United States. So I don't know where this is headed. I don't perceive that there's really any great risk to, nationalization of uranium assets or anything like that. I suppose there is maybe a risk that the United States gets into a spat with the current regime. I think it's more likely that they're going to work this out. But one way or another, I thought that Global Atomic was a screaming buy when it was north of $3. Our friend Justin Hune over at uraniuminsider.com thought the same thing. He thought it was a buy around $3. And we ended up touching almost down to $2 in this reaction to the news in Niger. There is clearly geopolitical risk here. Of course, there's always the possibility that this stock goes to zero if you had, a nationalization or some really crazy kind of event. I don't think the political cards, as I'm reading them, are setting up for that kind of event. I think the U.S. is going to have to swallow a little bit of crow and eat their words, and they'll get to build their military base. And this is probably a deep value play. Everything else is off its bottoms, whereas Global Atomic is the only thing that's trading right on its cycle lows as we speak.
Eric, whether there was one more dip or not, and you got a chance to buy it a few dollars better, I think the consensus was on the show that this is a buy on dip. I don't see any reason why it's not. Ultimately, uranium had a great run. It was a 9-month advance that saw an extraordinary 100-plus advance. those rallies get checked. And after primary trend moves like that, these secondary corrections wash out weak hands, people that were chasing performance, people that weren't there for the high conviction, and or simply trend followers that got signals that the short-term trend was over. Ultimately, this is now retraced close to half of its gain. And after that kind of a correction is typically when buy-on-dip traders start to emerge. And so you can see on the chart that we're approaching the 50-day moving average. This would be a level where, if broken, and especially if we can get above $30 on this chart, that it may signal that we are resuming some sort of new bull trend. Have we beat the 50-day? No. Have we beat that $30 level? No. So there's a lot of things that still have to happen, but this correction has been already a month plus. It's already gone deep enough. So watching whether or not uranium starts to bull here is certainly on my mind.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the slide deck provided by Ole Hansen and the chart book we just discussed here in the postgame, including a link to a number of articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @Eric S. Townsend, that is Eric spelled with a K, and follow Patrick @Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.